I'm diving into the top 21 bookkeeping mistakes that can totally wreck small businesses, and I'm challenging myself to avoid all of them while I run my own. Let's see how I do. Bookkeeping mistakes are a silent killer of small businesses, and it's shocking how often they occur, even with the best of intentions. In fact, did you know that nearly 80% of small businesses fail due to poor financial management? That's a staggering number, and it's a reality check for all of us entrepreneurs. One of the biggest challenges small businesses face is managing their finances effectively. It's not just about keeping track of income and expenses, but also about making smart financial decisions that drive growth and profitability. Unfortunately, many small business owners lack the accounting expertise or simply don't have the time to focus on bookkeeping. As a result, they're more likely to make mistakes that can have devastating consequences. When you're struggling to keep up with bookkeeping, it's easy to let things slide, thinking that it's not that important or that you can catch up later. But the truth is, every small mistake can add up quickly, leading to financial chaos and even business failure. For example, if you're not tracking your cash flow correctly, you might end up with a cash crunch that hurts your ability to pay bills or invest in growth. Meanwhile, if you're not accurately tracking your expenses, you might be missing out on tax deductions or overpaying on taxes. And if you're not regularly reconciling your accounts, you might be missing signs of fraud or theft. These mistakes might seem minor on their own, but collectively, they can have a huge impact on your business's financial health. Let's dive into the 21 bookkeeping mistakes that can destroy small businesses. From mixing personal and business expenses to ignoring depreciation and amortization, these mistakes are more common than you think. Number 1, not separating business and personal expenses. This is a classic mistake that can lead to tax headaches and financial chaos. Number 2, not reconciling bank statements regularly. This can lead to missed errors or even fraud. Number 3, not tracking inventory accurately. This can lead to stockouts, overstocking, and lost revenue. Number 4, not properly accounting for sales tax. This can lead to legal issues and financial penalties. Number 5, not tracking employee hours and benefits accurately. This can lead to payroll disputes and compliance issues. Number 6, not accounting for depreciation and amortization. This can lead to inaccurate financial reports and missed tax deductions. Number 7, not maintaining a proper accounts payable system. This can lead to missed payments and vendor relationships. Number 8, not tracking cash flow regularly. This can lead to cash crunches and financial crises. Number 9, not properly accounting for investments and loans. This can lead to financial mismanagement and missed opportunities. Number 10, not maintaining accurate and up-to-date financial records. This can lead to financial chaos and legal issues. Number 11, not tracking accounts receivable accurately. This can lead to delayed payments and cash flow issues. Number 12, not properly accounting for assets and liabilities. This can lead to inaccurate financial reports and poor business decisions. Number 13, not tracking expenses by category. This can lead to missed tax deductions and poor financial planning. Number 14, not regularly reviewing and adjusting the budget. This can lead to financial mismanagement and poor resource allocation. Number 15, not maintaining a proper accounts receivable system. This can lead to delayed payments and cash flow issues. Number 16, not tracking company credit card expenses accurately. This can lead to financial mismanagement and missed tax deductions. Number 17, not properly accounting for inventory valuation. This can lead to inaccurate financial reports and poor business decisions. Number 18, not tracking employee expense reports accurately. This can lead to financial mismanagement and missed tax deductions. Number 19, not maintaining a proper payroll system. This can lead to payroll disputes and compliance issues. Number 20, not properly accounting for owner's equity. This can lead to inaccurate financial reports and poor business decisions. And number 21, not regularly seeking professional accounting advice. This can lead to financial mismanagement and poor business decisions. Each of these mistakes can have a significant impact on your business's financial health, and it's essential to be aware of them to avoid falling into common traps. The most critical mistake that can lead to business failure is not tracking cash flow regularly. Cash flow is the lifeblood of any business, and if you're not keeping track of it, you're flying blind. You might be profitable on paper, but if you're not generating enough cash, you're at risk of going out of business. This is why it's essential to track your cash flow daily, weekly, and monthly to ensure you're staying on top of your finances. Cash flow issues can sneak up on you quickly, and before you know it, you're facing a financial crisis. By tracking your cash flow regularly, you can identify potential issues early on and take corrective action. This might mean adjusting your pricing, managing your accounts receivable, or reducing expenses. Whatever it takes, keeping a close eye on your cash flow is essential to maintaining financial stability and avoiding business failure. In conclusion, avoiding these 21 bookkeeping mistakes is crucial to ensuring the financial health and longevity of your small business. Remember, bookkeeping is not just about crunching numbers, it's about making smart financial decisions that drive growth and profitability. If you've got a horror story about a bookkeeping mistake that nearly destroyed your business, share it with me in the comments below. And if you're struggling with financial management, be sure to check out my related video on financial management tips for small businesses.